Ever heard the one about the man who claimed working overtime isn't worth it because all the money goes to taxes anyway? Yeah, he's probably the same guy who thinks the moon landing was staged. You see, there's a common misconception floating around that the more you work, the more Uncle Sam takes. But here's the thing, it's just not true. Now I know what you're thinking. Taxes are about as exciting as watching paint dry, but stick with us because we're about to make them a whole lot more interesting. We're going to debunk this myth, exploring the ins and outs of our progressive tiered tax system and showing you exactly where your hard-earned dollars go. You'll see that every extra hour you put in isn't just lining the government's pockets. So grab your calculators and your sense of adventure because we're about to take a deep dive into the world of taxes. So buckle up as we demystify the tiered tax system and show you how your hard-earned dollars are really taxed. Okay, so let's get one thing straight. The tax system isn't some scary monster under your bed. It's more like a multi-layered cake. Delicious, right? Imagine a cake with several layers, each one a different flavor. In our tax cake, these flavors represent different income levels. Let's call them tiers. Each tier has its own tax rate, and this rate applies only to the income that falls within that tier. That's the essence of a progressive tax system, the one we use here. So let's say your income places you in the third layer of our tax cake. The tax rate for this tier, let's say it's 25%, only applies to the slice of your income that falls within this tier. The rest of your income, the part that falls in the first and second tiers, is taxed at their respective lower rates. Now what happens when you earn more, say from working overtime? Well, that extra income simply gets added to the top of your current layer, or if it's enough, it might even start a new layer. But, and this is crucial, it doesn't change the amount you're taxed on the lower layers. Those remain the same. So you're not losing more from your initial income, you're just paying a higher tax rate on the additional income. Here's another way to look at it. Let's say you've been climbing a mountain, our tax mountain. As you climb higher, the air gets thinner. In our case, the tax rate gets higher. But the air at the bottom of the mountain where you started doesn't get thinner just because you've climbed higher. In the same way, your lower tiers of income aren't taxed more just because you've earned more. This tiered system is designed to ensure fairness, so that those who have more pay more and those who earn less pay less. It's a way of making sure everyone contributes their fair share depending on their ability to pay. So, contrary to popular belief, working overtime isn't a wasted effort. Sure, you'll pay a bit more in taxes, but you'll also take home more money. And remember, the higher tax rate only applies to your overtime pay, not your entire income. And here's one last sweet bit to chew on. Tax deductions and credits can actually lower your total tax bill. Think of them as cherries on top of our tax cake. They can reduce the amount of tax you owe, and in some cases might even push you down into a lower tax tier. So the next time someone tells you that all your overtime pay is going to taxes, you can tell them about the tax layer cake. Who knows, you might even get a slice. Now that you understand the basic structure of the tax system, let's take a closer look at how much of every dollar you actually keep. Imagine you're working overtime and you're earning an extra dollar. Now, the question is, how much of that dollar do you actually get to take home? Let's break it down. If you're in the 10% tax bracket, you'll keep 90 cents of every dollar you earn. That's right, you're only giving 10 cents to Uncle Sam. Not too shabby, right? Now, if you're in the 22% tax bracket, you'll keep 78 cents of that dollar. Yes, the government gets a bit more, but you're still pocketing the majority of your overtime earnings. And let's say you're in the top tax bracket, which currently sits at 37%. You'd still keep 63 cents of every dollar earned. And remember, this is for the top tax bracket where the big bucks are made. Here's the part where people get confused. Let's say you're on the border of a tax bracket and some overtime work bumps you into the next tier. You might be worried that all your earnings will now be taxed at this higher rate, but that's not the case. Only the income that falls into that higher bracket is taxed at the higher rate. The rest of your income is still taxed at the lower rates according to our friendly tiered tax system. So if you're contemplating those extra hours, remember this. Earning more money doesn't mean you're losing a larger proportion of your income to taxes. It means you're earning more money, plain and simple. Think about it like this. Would you rather have 63 cents from a dollar or none of it at all because you didn't work the extra time? It's like leaving free money on the table. So, working overtime isn't just padding the government's pockets, it's padding yours too. But wait, there's more! Your paycheck isn't the only thing the tax man is interested in. Just like a magician pulling a rabbit out of a hat, the tax system has a few more tricks up its sleeve. It's not just your hard-earned salary that gets a visit from our friend, Mr. Taxman. Dividends, rental income, and capital gains also join the party. Let's start with dividends, shall we? Picture this, you have shares in a company, and that company decides to share some of its profits with you. That's what a dividend is, and yes, it's taxed. But here's the twist. Dividend tax rates are usually lower than your regular income tax rates. In fact, qualified dividends can be taxed at a rate as low as 0%. It's like a buy one get one free deal, but for your money. Next up, we have rental income. If you're a landlord, the rent you receive isn't just free money, it's considered income and it's liable to be taxed. But don't worry, the tax system isn't all take and no give. You can deduct certain expenses related to your rental activity like repairs, insurance, or even the depreciation of your property. So, it's not all doom and gloom, folks. Now, let's talk about capital gains. If you sell an asset like stocks, bonds, or real estate for more than you bought it for, that's a capital gain. And you guessed it, it's taxable. But, just like with dividends, the tax rates on long-term capital gains are typically lower than those on regular income. So, if you're into investing, the tax system can actually work in your favor. Now you might be thinking, great, lower taxes. But I'm not a billionaire, how does this help me? Well, here's the thing. These lower tax levels aren't just for the wealthy. If you, as a middle-class individual, save and invest your money, you can benefit too. It's like an all-you-can-eat buffet, but instead of food, you're getting tax benefits. You see, the tax system isn't a big bad wolf out to gobble up all your money. It's more like a game of chess. The rules might seem complex, but once you understand them, you can use them to your advantage. And just like chess, it's a game anyone can play, not just the rich and famous. So, let's circle back to the main point. Sure, overtime might get you a bit more tax, but that doesn't mean it's not worth it. And when it comes to dividends, rental income, and capital gains, the tax system might actually be your ally, not your enemy. So, remember, investing isn't just a game for the rich and famous. With the right knowledge, you too can reap the benefits. After all, who doesn't like a good game of financial chess? Checkmate, Mr. Taxman. Phew. We've covered a lot of ground today, haven't we? Let's do a quick recap. We've dissected the tiered tax system, showing you that it's not a one-size-fits-all approach. Instead, it's a progressive system that taxes different portions of your income at different rates. We also broke down just how much of every hard-earned dollar you get to keep in your pocket. Then we ventured into the world of other taxed incomes. We discussed dividends, rental income, and capital gains, and how these tax levels can benefit not just the wealthy, but also the middle class, if they're smart about saving and investing. If you found this information useful, do us a solid and hit that like button. And don't forget to subscribe to the channel for more insightful content. Thank you so much for sticking with us on this journey through the tax jungle. Remember, knowledge is power, and in this case, it might just help you save some cash. So until next time, keep those questions coming and those dollars rolling.